Thanks for joining us for our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, starting out with our chart of the week here, this one comes to us from Ned Davis Research. Now, last week they posed the question, if everybody's all in, who's left to buy? So they showed this chart here, and it's stocks as a percentage of holdings at institutions. You can see those are insurance companies and pension funds. And we can see that at 54%, stocks comprise a near record allocation in those pension and insurance portfolios. Similar statistics can be seen when we're looking at household allocations or international holdings as well. But there are some key offsets to this narrative of everybody already being fully invested. So, on the supply side, there are less publicly traded stocks. So, this chart here shows how the number of public listings resumed a long term downtrend around 2022. And another important offset is that corporate share repurchases or buybacks are at record levels. This has been a steady source of demand and also lessened the supply of shares. And not shown here is the fairly price insensitive buying in defined contribution retirement accounts like 401ks. Estimates from data that we get from Vanguard suggest that there could be as much as $600 to $800 billion in stock demand each year just from defined contribution plans. So, yes, investors may be all in, but there's important offsets that make their allocations less concerning. So, turning to corporate profits, the current earnings season is looking solid. It's tracking double-digit growth. And that's good news both for stocks and the economy. The chart here shows that there's never been a recession in which profit growth is positive. It's a circular relationship. When profits are growing, companies tend to keep up their hiring or at least maintain their employment figures. And this chart here shows that the labor market has, in fact, been stabilizing after backing up some since 2022. So the blue line here is the job losers rate, and the orange line is the unemployment rate, and both have recently turned lower in their most recent updates. The other thing that companies tend to do when profits are growing is they tend to invest. And again, we're showing investments contribution to growth, and that recession typically sees negative investment growth. Recently, investment growth has actually accelerated. So, as long as that profit cycle remains positive, it's likely that the expansion is going to remain intact and stock market corrections could remain contained rather than morphing into full bear markets. Now, of course, we're still keeping an eye on developments here in the energy market, and that's because the markets themselves are telling us that it's important right now. Sometimes oil and stocks can mix. They can both move up together, especially early in an economic expansion. But in geopolitically driven oil dislocations, they tend to move opposite of each other. This chart is showing the percentage of days in the past 50 days that oil and stocks moved in opposite directions, and it's about three-quarters of the days. Now, the good news is that oil prices tend to recede in the 12 months following a geopolitically driven spike. So, this table from Strategas shows 22 past events, and in some cases, oil was higher a year later. But in 14 of those 22 cases, it was lower, and the median loss for oil was 10%. If history repeats and oil drifts lower over the next year, that could be a positive development for stocks. Now, here we're showing a simple indicator that just looks at the change in oil over the past year. We can see that for now, it's in a zone that has been negative for stocks, but falling oil prices have tended to be met with better than average returns. So that could be a tailwind if oil begins to recede. So, just touching briefly on the market trend here. The rally off the lows was impressive, but we don't think it's reached escape velocity yet. We want to see a very high percentage of stocks rallying in unison to sign that all clear signal with more confidence. We just haven't gotten quite enough participation for us to check that box yet. We still expect a volatile summer ahead. So, to wrap everything up here, investors appear to be fully invested, but there's some important offsets, including fewer shares listed, corporate buybacks, and defined contribution plan investments. Profits are tracking a solid first quarter. Double-digit profit growth is supporting the labor market as well as corporate investment. And we still need to pay attention to oil prices. But the good news is that historically, oil prices have eased in the year after the onset of a geopolitical event. And from a trend perspective, the rally off the low was impressive, but hasn't delivered the indicator improvement that we'd like to see to feel more confident that the volatility is behind us. Our base case remains intact, and that is for a challenging summer ahead. So that's what we've got for you today. And as always, I want to thank you for joining and wish you a great week ahead.